Welcome aboard the Pilot Money Guys podcast, where our mission is to help professional pilots build and protect wealth on their journey to financial freedom. This podcast is brought to you by Leading Edge Financial Planning.
Hello. Welcome to Pilot Money Guys. I'm your host, Charlie Mattingly. I've got my trusty co-host, Andy Christopher. We're with Leading Edge Financial Planning. And today, Andy, we're here to talk about an exciting topic, or a topic that you didn't think was exciting that really is exciting. You just didn't know it.
Yes.
So hang on today. We're here at Pilot Money Guys. We are glad you're here. We appreciate our pilot tribe, our pilot audience. Please share the podcast. It really helps us to reach more people. Rate and review. Helps the algorithm gods shine favorably upon us and just have reach more people, help those folks out. And again, our mission, Andy, is just to deliver some actionable ideas, simplify complex topics, cut through some financial noise to help our folks build a mindset for financial life success. And today, the topic is a little bit complex. There's no oversimplification. There's no oversimplifying. There's a lot of moving parts. And so we wanted to bring that to our pilot audience. So today we're going to talk mainly about indexing, how it works, the progressive nature of used to be stock picking, used to be maybe some active mutual funds still out there, indexing, and then some other strategies that we talked to. Yeah. But today's a little bit deep. So we're going to open the framework. I'm going to stop talking, Andy, and hand it off to you to introduce our guest, Rob Harvey, and then what we're talking about today.
Yeah, perfect. So we've got, jumping into the show, Rob Harvey. I think their audience and our listeners they're gonna love this because as you said, Charlie, it's not simple. And we're talking about indexing, which I think most people, when they think about indexing, are like, that's pretty simple. That's just, that's the easy boop button when you want to invest. And there's some nuance there. But let me just talk about our guest today is Rob Harvey. He's from Dimensional Fund Advisors. He's their co-head of product specialist. And he's a vice president. He's also a chartered financial analyst. He's kind of serves as the subject matter expert for Dimensional's equity portfolio and performance. He's on the road a lot talking about just what it is that they're doing and implementing at Dimensional. But joined their team in 2016 as an associate portfolio manager. Prior to his current role, he was a portfolio manager in international and emerging markets, as well as their domestic equity portfolio. So there's a lot of experience, I think, in the nitty-gritty side of the portfolio management, just from the person who's pushing the buy and sells. Before Dimensional, he was in the Treasury Department at Cisco Systems, so trading their foreign exchange, fixed income portfolios, and their share repurchase program. So wealth of experience just inside and outside of Dimensional. Has an MBA from the Haas School of Business at University of California, Berkeley, Bachelor's of Science, and a Bachelor's of Arts, which we didn't ask about this, in German from Villanova University. Nice. Pretty interesting.
Yeah, absolutely.
But yeah, I think great topic because just as I already said, it's really not simple when you think about indexing. And Rob does a great job of just kind of peeling the layers back about what it means to be an index investor. And in other words, you go and you say the Vanguard US Large Cap Index. You're like, surely that's just an index fund. Well, it's like, well, it matters, right? And Rob talks a great deal about, okay, what index or what benchmark are you following? And then how are those rules actually set up by the index providers, which isn't Vanguard or BlackRock or what have you. So pretty interesting stuff, Charlie.
Yeah. Andy, I was amazed and learned a ton just in preparation and our discussion that you could pick, for example, I want a small company or small cap index. Yeah. Boy, that's a wildly, wild variation on what type of index you pick. And you're going to get some very different performance. And he talks about the differences in performance between indexes that we might think are the same.
Yeah.
Can vary quite a bit, as can the cost inside the index, as can, the concentration. So Andy, today, without getting into too much detail, I want to introduce a couple topics that we're going to address. And so I want our listeners to understand, we're going to talk about passive versus active, and so I think in that realm, think active as in a person, maybe in a mutual fund, making all the decisions on how to construct that mutual fund, when to buy, when to sell. That's an active, an example of what we mean when we say active. Now, there's a whole spectrum, and then the passive might go all the way to the other end where you buy one global ETF and you never touch it. And or it's never changed inside of the ETF. So there's the whole, and then there's lots of things in between. But Andy, that's something we kind of refer to today. I want people to understand.
Yeah, absolutely. My takeaway was there's no such thing as a passive investor, right? There's active investing, which is just like you said. I think, NVIDIA is going to outperform, right? I'm going to go buy, and Dimensional and Rob and his team is pretty interesting. We work closely with Dimensional. We use them in our portfolios, so they're a great resource. Of course, we use other providers, and we always want to evaluate just how we use fund providers. But I would say they're kind of a hybrid, right? So they're not index investors, but they're not active in the sense of they're going out and picking stocks. But they do like the idea of there are these rules in index investing that kind of don't make sense from just a pure trading efficiency perspective. And maybe we can get the benefits of indexing, which you and I, Charlie, talked about. Indexing, I think, is a net positive for the investing community and for retail investors and people saving for retirement. But how do we leverage those benefits while, again, not being beholden to these draconian rules of I have to sell at 4 p.m. on this day with everybody else? Right? So I think that's a really interesting topic that our listeners are going to learn a lot from.
Yeah, and a highlight there is that indexes were created as benchmarks, and then we made them into investments. So there's some rules there that you're referring to that are not so favorable. But a couple quick terms before we hand it off to our podcast and Rob Harvey is, we use a lot of terms like we talked about passive, active. We talk about index construction and providers. I'm not even using the right terminology. MSCI, Russell 2000, CRISP. Those are all index construction companies. Help me, Andy. Help me bail me out on that one. That's I'm picturing just a bunch of people sitting around with their hard hats on. The index. We're the index construction company. That's right. But I'll use the Vanguard example. Vanguard again. They say we're going to build this is the U.S. large cap, but then they have to go and look at the rules of the benchmark they're following, which might be CRISP or it might be Russell or it might be S&P. And those are the guys and girls with the hard hats on in the boardroom deciding, okay, these are the rules for a company needs this much time of profitability, right? S&P 500 classically 12 months. These are the rules for whether they're considered a value or a growth stock or a small cap or a large cap stock. And these are the rules for when we're going to rebalance and add and delete, right? And so the construction company is making the rules. They're building the index, and then Vanguard, BlackRock, State Street, they go in and have to just follow the rules. So it's just pretty straightforward if you're the actual asset manager, and then your goal really is just to follow. I'm just going to keep using this construction analogy, Charlie. It works.
It's just follow. It's just follow the blueprint exactly the way the construction company laid it out, and don't deviate. Right, you know what I mean? You wanted, maybe you wanted a different landscape. Nope, you got to do it this way.
Andy, don't deviate unless it's SpaceX.
That's right, exactly.
So we're going to talk about that. That is a sneak peek into what we talk about because that's a fascinating example. Yeah. So.
Yeah. And that's when you change the blueprint, right?
That's right. You change it. You go back to the construction company and go, hey, wait a second. We got SpaceX. But anyway, it's going to be interesting. I think they're going to learn a lot. So without further ado, our podcast with Dimensional Fund Advisors, Rob Harvey. Awesome. Well, welcome, Rob. We are so excited to have you today from Dimensional Fund Advisors. Thanks for taking the time today. And we're excited about our discussion together.
Yeah. Thanks for having me on. I'm excited to be here.
Absolutely. Yeah, we're going to hit it. We're going to hit some tough topics today, some fun topics about passive, active investing, index investing. And I think our audience is going to learn a lot because I know I did, Rob, just kind of preparing for this podcast, man. Nothing's ever as simple as we want it to be, is it?
No, that's exactly right. And I think a lot of times you kind of give credit to say, well, the index is the market, right? What kind of due diligence or digging do I need to do? Well, there's a lot. We're going to do some of it together today.
I love it. And I think our clients and our audience, our professional pilot audience, and they're going to get a lot out of this because there's a lot of those that are going to learn that there's an optimal way, better way to think. And they're going to get educated on some things that we didn't know about before, such as how index are designed, constructed, pros, cons, alternatives that you're going to talk to us about. So I'm excited about all that. I learned a ton just digging in myself. And I think that our audience is very high achieving and they want to know how to do it right. And so they're going to learn a lot today. So we appreciate that. But for the most part, Andy's going to be driving this discussion. He's our leading edge Chief Investment Officer. So he's excited about this topic and has kind of designed the outline without me, Andy. So, I mean, that's probably the best thing to do there. So I'm excited, Andy, for you to drive this conversation.
Yeah.
And I'll, like I told you before, I'll kind of pilot proof it as required. So if we get a little high level, but over to you, sir.
Yeah, I'm super excited. I mean, I think we're, and having you here with us, Rob, is awesome. We're going to go to Index Bootcamp today and we're going to build an index together. And so I think it's just really helpful, right, to understand that. And I think the research that, in particular, Dimensional Fund Advisors has been doing, right, is really interesting because I think there's this idea of like you're an index fund and you do your index thing, which we're going to talk about. You're an active investor, you're picking stocks. And I think the research that you and your team have done is, like I said, super interesting because you can get those benefits of the market, the price discovery and efficiencies, but maybe not be forced to follow this rigid indexing construct and so some of those things that you kind of get backed into a corner from an indexing perspective. So I think it's going to be really interesting today.
Yeah, and a lot of times historically when we talk about active versus passive, people will say, okay, well, indexing is in the passive camp, and then stock pickers, like you said, are in the active camp. And actually, they're a lot closer than you might think they are. And so we're going to talk a little bit about also some of the decisions that get made about what goes into an index and when, right? And then also, are those decisions that we agree with? Is it the right way to do things? And if not, what's a better way to do it?
Yeah, I love it. So let's just jump in. I mean, let's just go, like I said, indexing 101, just Rob, real simply, like, to you, what is an index fund? When you're an index fund, like what is your primary number one goal as an index provider?
Yeah, it's a good question because I think it's actually different from what a lot of people might expect. When you hire an asset manager or you invest in a fund, your expectation is that fund would try to achieve as high returns as it possibly can. And that's definitely true in the active management world. But actually, in the indexing world, the key metric that we use to evaluate whether or not an index fund is doing a good job is tracking error. And tracking error measures how closely your index fund lines up with the performance of the index that it tracks. And that means that outperforming the index is actually a bad thing. You don't want to do it. You don't want to underperform either. You want to be right in line with whatever that index is delivering. And so when you think about particularly for clients and investors, what do they really want? They want growth of wealth. How do you achieve growth of wealth? There's a few ways, obviously in terms of saving and spending, but also like you want your investments to do well. And what's important to note about the index fund is they do not care about doing better or worse than the benchmark. In fact, they do care. It's just the opposite. They don't want to have any daylight between them and the index. And so that kind of creates some interesting problems for us because when you think about some of the things that we're going to talk about today, some of the shortcomings associated with indexing, you might think, is Dimensional the only one who knows about this? Are we the only one who are talking about this? No, it's well known in the industry. So why isn't anyone doing anything about it? Well, the index funds aren't incentivized to do it because, again, the metric that we use is saying, how close are you to the index that you're tracking? And as long as you're close, nothing else matters. Right?
Yeah. Yeah. It's super interesting. In other words, if you're an index provider, you get a trophy if you're down 20%, but the index was down 20% as well. You're like, we killed it this year.
Exactly.
We hit our goal.
The absolute number doesn't matter. And the relative number, higher would be worse. So you think about, if you're an index fund and you find a way to guarantee yourself 50 bips, 100 bips of outperformance versus the index every year, you'd be the worst index fund manager in the world, right? No one would hire you because you didn't do what you said you were going to do, which is minimize tracking error as much as possible. So indexing is being a little bit less than the benchmark because you have to remember too, like obviously if you're in line with the index, it's not suboptimal, it's just average. But index funds usually perform a little bit worse than the index because you got to pay fees. The fees aren't a lot, but there's something. So when you choose to index, when you choose to invest in an index fund, you are guaranteeing yourself permanent level of underperformance. You will always underperform, always. And maybe that's okay. And we'll talk about, sort of why we are where we are in the industry right now from that standpoint. But that's not really a proposition that gets a lot of people out of bed in the morning, right? Like I'll always underperform.
Yeah. That's super exciting. Yeah. I think, Rob, one of the things I think about when we say indexing is, and I'll use Vanguard as an example, because people will say, Vanguard, they think they do quite a bit of indexing. They've gotten obviously more into active management, specifically on the fixed income side. But, people think iShares, Vanguard, they're index providers, but they're not the ones making the decision, right, Rob? In other words, they're not deciding the index, right? So maybe kind of help us understand, when Vanguard says we're the U.S. large cap, that's the CRISP, whatever U.S. large cap index. Well, that's not Vanguard. That's someone else, kind of think Wizard of Oz, the man behind the curtain kind of thing going on here.
Yeah. And that actually creates some interesting problems as well, right? Because again, you're invested in an index fund and, maybe you have questions about what the index is doing and you go to the portfolio manager at some of the asset managers that you mentioned before, State Street, BlackRock, Vanguard, and they'll have an explanation as to why they're doing what they're doing. But ultimately the explanation is going to be, well, the index is doing it, right? So, and we're just doing whatever the index is doing. So if you want to follow, why did the S&P not include this name? Why did CRISP include this name? Why does Russell rebalance that many times a year as it does? Your portfolio manager will have an answer for you, but they're not the ones who are deciding that. That's actually, as you said, a third party. And so there's index providers who make the decisions about what go into indices and when. And then there's index fund managers who actually manage the money to track the index. And they're different. They don't sit in the same house. And that, again, is in some ways like there's a sort of a third party, like arm's length, if you want to think about it that way, or arrangement there. But also what we're going to talk about is sometimes some of the problem solving associated with this, right, falls through the cracks. And that's even true with fiduciary duty. Like who is responsible for some of these decisions? They're both going to point sort of at each other. And then there's just sort of this void there to say, like, who is responsible, right? So that's important to note. There's this index providers and index funds are different.
Yeah, great point.
So Rob, I mean, I hear what you're saying is like, there's these multi-layers of construction and just to peel the onion back, what I hear you saying and what I've learned today as well is like the providers or the index construction team, if you will, varies quite a bit on how they do that construction. And then you might have some variability in how Vanguard executes it versus State Street, or that's kind of what I was surprised at as well. And then there's some variability on maybe an exact same index with very different fee structures as well. And so I kind of found that interesting, to hear you say that as well.
Yeah, one of the best examples you can think about with that is, if you look at the S&P 500, for example, SPY is the best known and most liquid, at least as of now, S&P 500 index fund that's out there. SPY is expensive for what it is. So it's quite a few basis points more than what you'll get with alternatives in the market. And SPY is a State Street product. State Street also has another product that also tracks the S&P 500 that's much, much, much cheaper. And so they undercut themselves. So why is one more expensive than the other? Well, SPY has a ton of liquidity. It has a ton of volume that trades every day. So they can charge you more. And then there's a product that doesn't trade as much and they have to charge you less. So even in the space of just tracking the S&P 500, there's lots of different options about what are the fees and what am I paying for really?
So in other words, and we'll talk, Rob, if you go out and say, hey, I want to go get an S&P 500 index or any index fund, you've got to make some decisions. But maybe as we kind of go through this, we'll wrap up this Index 101. I want to go a little Schoolhouse Rock with you, Rob, and just, I'm just a stock, sitting on the stock exchange. How do I get into an index? Who's making that decision? How am I getting rebalanced? And then how is that State Street Vanguard? Like, what does that trading mechanic look like if I'm this position that's getting added or deleted from a particular index? And of course, as you noted now, Vanguard, whose only mandate is to track that index, has to go in and trade on that particular day.
Right. Well, this is a good one to talk about because we've got a few major names IPOing in the US this year, or at least one so far, but we're slated for potentially some additional ones. So let's talk about what happened with SpaceX, because this is a really good example of the different decisions that are being made by different index providers. And how does a stock make it from just sitting on the exchange to actually being in an index fund and having all those flows track it? Indices in general and index providers like MSCI and CRSP and Russell and what have you have rules about when you're eligible to be included in some of their indices. And it's different for different indices, but usually they have rules around like, how big do you have to be? What exchange are you trading on? How liquid are you, right? So those are all important considerations. And then some indices have additional considerations on top of it, like you have to be more seasoned or there has to be a certain level of free float for you and what have you. SpaceX was really interesting because it didn't meet the criteria for a lot of indices out there. A lot of indices require you to have at least 10% free float. SpaceX didn't have that. Some indices that require you to have profitability. SpaceX definitely didn't have that. Most indices require you to have a certain amount of seasoning, like you have to trade for a certain amount on the market before you get added to the indices. And obviously with an IPO, you don't have that, right? So indices kind of had some interesting decisions to make, although it doesn't really seem like there was a decision because there's rules, right? So you think, okay, well, they're going to follow the rules. Well, the rules can get changed. The rules can get broken. So one of the things that we saw, which was, we mentioned the exchange, right? A securities out there and it's sitting on the exchange. But one of the things you have to think about is if you're Elon Musk, how do you decide which exchange you want to list on? Right? You could list on NASDAQ, you could list on NYSE, and there's plenty of other exchanges out there. NASDAQ and NYSE are kind of the big ones. But what's interesting is NASDAQ also runs an index. They're an index provider, right? So if Elon is interested in having index fund demand scoop up shares of SpaceX, one thing NASDAQ can do is to say, you know what, we have these rules about including SpaceX into, or just any IPO into our indices. But, we're willing to bend some of those rules for you, as long as you bring that listing over here, right? And so as you saw, NASDAQ has made, some changes to their index methodology. They fast-tracked SpaceX, and they also upsized what SpaceX would be in NASDAQ because, again, the free float is very small, and NASDAQ historically at least has been sort of a free float weighted index. And it's like 3x whatever the free float is because it wasn't very meaningful before because SpaceX just didn't have a lot of it. And then they listed SpaceX very, very quickly afterwards. Where is SpaceX listed? It's listed on NASDAQ, right? So that's an important consideration. Yeah. But then one of the other things I think about too is they're not the only ones to have thought about some of these rules and thought about like, well, when should we add this stock? And the S&P I think is a fascinating example because the S&P has rules about seasoning, it has rules about profitability, it has rules about free float, and all of those things came back, no, we won't add SpaceX, right? So it seemed very clear cut that the S&P wasn't going to be adding SpaceX. But the S&P Index Committee essentially went out to the general investing public and said, look, we've got these rules, but we're willing to break them. If you guys want us to break it to add SpaceX, we'll do it. So just tell us what you want. And to me, I think that's a really interesting decision and highlights exactly what some of this conversation is, because if you have rules, you kind of expect that the index provider is doing that because they believe that they're the right thing to do, because they think that that is the best way to grow wealth or protect from downside risk, right? And here, you just see them kind of throwing in the towel a little bit and saying, I don't want the responsibility of this decision. You make it. And then you can't come back to me and be upset because you're the one who made it, right? Because obviously if you get the call on SpaceX wrong, you're going to look like an idiot. No one wants to sort of miss out, and also no one wants to hold a dog either. And so what ended up happening was investors kind of came back to them and said, no, you have rules, stick to your rules. And they're like, okay, fine, no SpaceX, that's whatever you guys want. But to me, it was the pushing the decision back onto other people, right? Like that's the part that I think is concerning. If you board a flight and your pilot gets on the intercom and says, hey, you know what? We've got some storms coming up ahead. We could go through it or we could go around it. And your business is really important to me. So you make the call. What do you want to do? That's not a flight I want to be on, is it? You're like, you're the professional. You make the call about what you think is right. Maybe I agree with it. Maybe I don't, right? But I want your opinion. I want you to go with conviction about what you think is right. Not this like sort of throw it back to the general investing public, because that just shows that you just maybe don't have the confidence in what you're doing the way that people thought that you did.
Yeah, like a lack of discipline. It's a little disappointing to see that story play out. But Rob, can you take a few seconds to hit on free float for us and help us understand that a little bit?
Yeah, so free float is basically, of all the shares that the company has, how many of them are trading openly on the market versus how many of them are being sort of held by insiders. And usually what you see is post-IPO, free float tends to be lower. You have a lot of people who are insiders, executives at the company, for example, who are locked up. They can't sell their shares. And then that free float increases over time. And that's going to happen with SpaceX. It already is happening with SpaceX, right? Where more and more people get to sort of release and from that lockup and trade their shares the way that they want. But most indices kind of require you to have at least 10% free float. There's been exceptions before, but SpaceX was not at that level in its initial IPO.
Yeah. Who knew we were going to talk about SpaceX on this?
Well, I guarantee you, everybody out there, doesn't matter if you're an advisor, asset manager, individual investor, have had questions and conversations about, do you hold it? And when did you buy it? Right? That's good questions.
It is a perfect perfect microcosm, perfect story to illustrate this thing. I think it's fascinating.
Absolutely.
But
yeah. And this is the thing about talking about indexing. It's the gift that keeps giving, right? This isn't like a once every 20 years they do something weird. It's like all the time there's interesting things happening. You could be like, hey, let's kind of zoom in on this one and talk about it in a little bit of detail.
Super interesting. I think one of the ways we can show this and illustrate this, and Rob, is you've looked at the different S&P, or I should say small cap index providers, and actually looked at the return dispersion, right? And again, if I'm an investor, I'm like, I want small cap in my portfolio. I think that's important. Small cap index, right? And you might think you're getting exposure, a consistent exposure to small caps of smaller companies, but maybe that's not necessarily the case.
Yeah. So two things I think are really great points that you brought up. One is, if you're investing in an index fund that says small cap, value, quality, whatever it is, we'll stick with small cap for this example, you think that you're capturing a broad part of the market, right? So you're like, well, the different indices probably do it differently, but how different could they really be? Small caps are small caps, aren't they? And actually, when you look at just three indexes alone, which is the S&P 600, the CRSP US Small, and the Russell 2000, which are all very, very well-known and highly used US small cap indices, on average, over the last 20 years, the difference between the top performing and bottom performing US small cap index of those three has been like 5% a year, roughly, which is enormous. That is a huge difference between what you thought was basically a non-decision, right? It doesn't matter if you're in the S&P 600 versus Russell 2000, right? You maybe picked one because you like the name or the fees or whatever it is. But it's just that return dispersion is enormous. Yeah. And you can imagine that if you were in one of these funds and you underperformed another index fund by 12% in a year, which, as you can see on the slide, does happen, you've got some questions that you need to answer, right? Like, why did that happen? Like, what was sort of driving that? Because obviously, if the returns are that different, then the funds must be doing very different things. And this kind of leads to the second point that you were talking about, which is, are you getting small caps in each of these indices? And the answer is, it kind of depends. Sometimes you are and sometimes you're not. But, how many small caps or what percentage of the index you're getting that is in small caps and which ones they are matters. So Russell just went through a reconstitution. Historically, by the way, the Russell has only reconstituted their index one time in an entire year. The only time that the Russell would ever update their holdings was the third Friday in June. That was it. Anything else that happened throughout the rest of the year didn't matter. They'd fix it in June. Now they've revolutionized finance, if you want to think about it that way, and now they're reconstituting themselves twice a year, which I still think is ridiculous. But they've at least doubled the amount of reconstitution that they're doing or changes that they're making to the portfolio. Okay, good. But what happens is, if you only watch your index or your holdings once a year, you end up holding enormous names in them. They did hold, as of June, at the beginning of June, a company called Bloom Energy, which is like a $75 billion company. And the Russell 2's weighted average market cap is like $4 to $5 billion. And so it just did not belong in that index at all. And when you look at that, you might think like, well, again, the label says small cap. Russell 2 is probably the best known small cap index in existence. So of course I'm getting small caps. And actually, as we've shown before, prior to this reconstitution event, 40% of the Russell 2000 was invested in stocks that were not the smallest 2,000 stocks in the US. The kind of Russell 1000 and the Russell 2000 after that, like in terms of the market cap run sum. You probably thought you were getting names that were at 1001 all the way down to 2001, and you weren't. Some of them you were getting, but a lot of them you were much, much bigger than that. And part of it is the reconstitution event, right? So I think that's also something investors need to think about, which is, you buyer beware. You look at the label and you say, okay, I know what I'm getting. You might need to do a little bit more digging than that.
And I think, Rob, the term used for that, as you describe, is style drift, right? Mm-hmm. So if you're an investor and you said, I want large cap value or small cap, you kind of have an expectation that the fund you're holding is a large cap value or a small cap. But if you only rebalance, say, on the third Friday of June, then companies don't only change their market cap or their book to market on the third Friday of June, right?
Exactly. My grandpa was a carpenter, and he used to say, measure to the millimeter, mark with chalk, cut with an axe, right? You kind of have this high level of precision of measuring something, and then you get a little sloppy with the measurement, and then you get really sloppy with the execution. It doesn't make sense, does it? And I think about that with small cap indices or value indices or what have you in an asset allocation. If you're thinking about, well, how much do I want in small caps? Is it 10%? Is it 20%? Is it 30%? You probably have put some thought into that. You're, okay, that's what I want. And I have reasons for that, diversification, returns, what have you. But then if the fund itself isn't doing anywhere near what you thought it was doing, then you don't actually have that asset class exposure, right? It's not a precise tool for the job. And I think that's what people also need to kind of step back and understand, which is, as you correctly said, the market's always changing constantly throughout time. Think about, I said the Russell is now going to be reconstituting twice a year. Think about what's happened over the last 6 months. The world looks very different than it did 6 months ago. Do you want your index to be, or your portfolio in general, to be accounting for some of that information? I would argue yes, but again, that's not really what's happening in index world.
Yeah. Rob, I think I remember some of these in reconstituting. I think we're using is that accurate to say it's a rebalancing of that index?
That's right.
That's kind of the similar.
That's exactly right. Yeah.
But I think I remember this. Maybe another case study was the GameStop.
Yeah.
And I remember going, do we own this or not? And that I think that would have been included in some of the indexes, right? It
Absolutely.
was just a crazy anomaly there for a while.
That's a great one because, GameStop in January of 2021, at the beginning of January, it was a small cap value name. So it was in the Russell 2, it was in the Russell 2 value. And then pretty much overnight, it moved to become larger than 40% of S&P 500 constituents. It was bigger than American Airlines and Whirlpool put together. It was massive. And what you might have expected your small cap or small cap value manager to do with GameStop is sell it because it doesn't represent the asset class anymore. If it's big enough to make it in the S&P 500, it probably doesn't belong in your small cap strategy anymore. And that's what we did at Dimensional in our small cap strategies, but the Russell just held it. They held it all the way until June. So, if you look at the pop that you saw, if you pull up a price chart of GameStop going back to January 2021, you see this enormous spike, $350 a share. And then it's gone, like within days. It just doesn't last. And so if you miss that opportunity to say, this doesn't fit the asset class, we need to take the money off the table, you never get that chance again, right? So I think some of that just what we take for granted, that basic, every day you want to have a portfolio manager looking at your stocks, seems important, right? Would you get on a flight where the pilot's like, all right, I'll pop in the back, I'll see you guys in 3 hours? I don't think so. You're like, no, I'd like you to be looking at things like on a little bit more constant basis. Like I understand there's parameters and risk controls in place, but can you watch them? Seems basic. Same thing with the portfolio. And it's just, again, indexing doesn't work like that.
Mm-hmm.
Yeah, I think we talked Rob style drift. That's super interesting. I think the other place where we see downside, and then we'll stop bashing indexing because I think there are some goods that are worth bringing out. But
that's true.
I think it's important, and the research that Dimensional has done is what happens to the price of a stock as it leads up to being added or removed. Because I think that's important from a portfolio implementation standpoint. From a portfolio management of how does the index provider have to do that, right? They've got to trade at this one very specific time. We all know this intuitively, right? If we are buying when everyone else is buying or selling when everyone else is selling, that we get sort of price pressures that might be unintended. But can you just kind of help us understand that a little bit more about, what is happening to the actual share price as we get near these reconstitution dates?
Yeah, that's a great point too, because so far we've been talking about what do you hold, right? And how does that change? But, you also make the good point of, well, these are stocks that have to be bought and sold in the market. And so there's a real world transaction that has to take place. And so I want to talk a little bit about the mechanism, because you mentioned this before, about how does a stock get, sort of added to the index fund? And I mentioned, well, there's a lot of decisions that get made in the index provider, your MSCIs, your Russells, your S&Ps, for example. But then someone has to actually go out and do it. And the way that indexing works is, again, like if you're an index provider, if you're the S&P, for example, your client is an index fund. So that's your client. What does your client care about? Your client cares about tracking error. They want to reduce tracking error as much as they possibly can. Okay. How do you provide good client service? You try to help them achieve the metric that they care about. So how do you help them reduce tracking error? Number one, you don't change your index that often, which is why indexes usually only change holdings or reconstitute quarterly, twice a year, once a year. It's not very often. But then the second thing is, and this is what you were bringing up, is when you do make those changes, you got to let them know way in advance, because you don't want to surprise them with a change, because if you do that, they may not be able to react to that in time, and then they're going to take tracking error, which is what they don't want. And so generally what you see with index providers is when they make these changes, when they add securities or when they delete securities, it's weeks, months, sometimes in advance that they'll give a heads up and say, here's what we're going to be doing, and here's when. And the index providers kind of make a note and say, okay, we'll make sure that we trade those stocks in. But everybody else in the market also makes that same note. So if you know that the S&P is going to be adding a name in a week, and S&P index funds are not going to be adding that name until that at the end of the week, you also know that you have a buying opportunity there, because index funds are going to come and buy it back from you at whatever price. It doesn't matter what price it is, in a week or 2 weeks. And that's exactly what you see here on the slide. So day 0 here represents reconstitution. This is the time where indexes are making that addition or deletion from their constituents. And therefore also what you tend to see is index funds buying or selling on that exact date. But the announcement has happened already. Like in the S&P, traditionally it's a week heads up, although they kind of do what they want. It can be 2 weeks, it can be a month, it kind of depends. And so if you're anybody else, you can buy it in advance of the index. And there's actually a big part of our business, just our industry, that is focused on front-running indices and index funds in particular. And so if you think about like major market makers, there was a story that came out relatively recently about Millennium. Millennium is a pretty big hedge fund, and they made billions of dollars in it was June of this year. I think it was like $6 billion or something insane off of front-running index funds. So there's a huge part of the financial industry that's dedicated to say, okay, look, there's more and more money coming into indexing. It's very transparent and it's very rigid. Can we do something with that information? The answer is yes, right? There's a lot of players out there who are happy to be on the other side of that trade, and that costs investors something. Like in the slide that you showed, it's about a 9% difference between the day that the S&P announces it's going to be adding a stock and when it actually does it. Who gets that 9%? It's not investors in the index fund. It's anybody else out there who managed to grab that stock for cheaper than when it got added to the index. And that's a problem, right? That's money that's being left on the table.
Yeah, absolutely. Yeah, I think that's super helpful to go through as you think about, again, style drift, reconstitution. But that said, I think there are some goods to indexing. I think over the history of indexing, right, we talked, Jack Bogle, Vanguard, all that. And as Charlie and I were talking before, we said, I think, if you're an investor and you just put your money into a passively managed index, globally diversified fund, I probably can't tell you that your financial plan is going to fail if you do that. You're probably going to be successful, right?
Yeah.
So maybe, Rob, just kind of like, what are some goods, right? If I'm an investor and I'm like, what are some goods you would say of indexing and maybe compared to like this sort of active management type strategy?
Yeah. And there are a lot of goods. So I don't want to pretend like, indexing is the worst thing ever, because, actually when you hear people like, Warren Buffett talk about, who can beat the S&P 500. Even Warren Buffett has come out and, as a sort of probably one of the most famous active managers this world's ever known, and said, look, if I were, advising someone on what they should do, put it in the S&P 500, put your money in the S&P 500, right? Like, it's very hard to do better than indexing. And I want to talk about this a little bit because there are great things associated with indexing. What does indexing have going for it? It's low fee. It's well diversified. It's transparent, right? And then the last thing that I want to talk about here is also the fact that when you invest in an index fund, you, as I said before, guarantee yourself a little bit of underperformance, but not a lot. Tracking error is usually very, very good in those index funds. They do a phenomenal job tracking indices. And that's not something that we can take for granted. Because when you look at the active management space, the landscape looks terrible, right? So if the odds of picking a successful active manager over a 20-year period is something like 16% net of fees have managed to outperform on an annualized basis, and less than half of active funds around 20 years ago are still in existence today. That is a dismal track record about why, in our industry, indexing has become the bigger of the two, right? And I think it was 2023 indexing assets overtook actively managed assets in the US. And you can understand why, right? Like, I think about this a lot too, because, they sort of say necessity is the mother of invention. It's like, well, why did in 1903, why did the Wright brothers decide to take flight? Was it just because they were very creative and, like they wanted to push things forward? Yeah, that was true. But also keep in mind that in 1903, cars went like 15 to 25 miles an hour. They broke down all the time and they were ridiculously dangerous. So we were like, is there another option out here? And then you kind of say, how about we take to the skies a little bit. So the same thing with indexing, right? Which is the reason that we have indexing is because active management really let us down. A long time ago, before you had indices, you didn't have benchmarks. And so you'd hire an active manager and they would tell you a story about how they did. And maybe you believed them and maybe you didn't. But you wouldn't really find out about how you did or how you could have performed until you talked to your buddy, right? At, whatever the, equivalent was hundreds of years ago of a gym locker room or a barbecue or whatever it was. And then they'd say how well their portfolio did, and maybe they were lying or maybe they weren't, but yours might not have looked quite the way that you wanted it to. And you paid a fortune for it. And so what happened was, people kind of thought, all right, let's come up with a sort of a broad group of securities to form a benchmark and just see how the active managers do against the benchmarks, right? So then you can actually measure their performance. And they did terrible. And as I said, they still do terrible. And so eventually somebody got the idea to say, if the benchmark is beating my index manager or my active manager, why don't I just invest in the benchmark? And so that was the creation of index funds, which was, we did it backwards almost in the industry. We built the fund to track the benchmark. And we had the benchmark because we wanted to figure out whether or not our active managers were doing well, and they weren't. And so that was kind of the birth of this movement from active management to indexing. And even in the time that I've been in the industry, I've seen just a huge shift. I mean, you mentioned some of the thought leadership that we've put into indexing. Even 10 years ago, active was really the focal point where we're like, listen, diversification matters. People aren't very good at trying to outguess the stock market. Your costs matter and, your turnover matters and all this great stuff. And indexing has all that. Now the conversation shifted a lot more to indexing and it makes sense. But I completely agree with you. If you're in an index fund, you're already taking usually a better step forward than you are with the average active manager. And that much must be said.
Yeah, no, thanks for breaking that down. I love how you describe, it's really benchmarks were the genesis of this indexing. It wasn't really the other way around. So that's
right.
Incredibly interesting. And maybe, if we could talk through, I think you laid out, there's really kind of 4 decisions, right? If you have to go through almost like your personal due diligence, if you're an investor and you want to invest in an index fund, but what are some things that you should look at as you evaluate different options and different fund providers?
Yeah, there's a lot, and there's kind of subcategories beyond this, because I think a lot of times people say, well, it's in an index, it's a passive sort of investment vehicle. Yeah. But I'd push back on that and say, actually, if you're investing in an index fund, the index provider is making some decisions, and so you have to think about what do I want to have my exposure look like to that? And so you have to think first and foremost about well, which countries do I want to be invested in? Which seems pretty obvious, right? Like emerging markets is emerging markets. Emerging markets isn't just emerging markets. If you look at the dispersion between emerging market indices over the last year, like MSCI versus FTSE, it's like well over 6%. I think it's like 9% over the 1 year period difference between those two. Why? Is because FTSE considers South Korea to be a developed market country and MSCI considers it to be an emerging market country. And so you read the label and you say, it's okay, well, it's emerging markets. It's like, well, what does that mean? There isn't sort of a universal definition on what emerging markets is. It's up to the index providers. It's up to the asset managers. So that's one helpful thing to think about. Another helpful thing about is like, what kind of stocks do I want to include in there, right? So if you think about, like we mentioned before, SpaceX, for example, like mega caps. Do I want to have small caps in there? Do I want to have sort of a broader array of securities, or do I want to kind of narrow it down? And if I want to narrow it down, how do I want to narrow it down? If you're in the S&P 500, you're buying into this sort of profitability component that, these major commercial indices like the S&P market themselves is having. And so that's sort of a different consideration as well, which is like, if you're going to whittle down the universe, how do you want that to happen, right? And then even, once you decide to invest in, like, let's say, for example, the S&P 500, you've got other decisions to make. Why am I doing it? Do I need liquidity? If I do, I'm going to pay more than that. Do I not need liquidity as much? Okay, well then, like, which asset manager am I going with? Because, just again, even just picking up a product that tracks an index, you could have wildly different fees and wildly different liquidity profiles of those vehicles. So there's a lot to think about from there in terms of like, which stocks, which countries, why are they doing some of those exclusions? And then also like, what am I paying for some of that? Mm-hmm. And there's other considerations that we have as well. Like, for example, your portfolio is going to make securities lending revenue from you. How much? How much of that does the index fund manager keep, right? Like, those are good questions too that you have to dig into a little bit. And those aren't on the fact sheet. There's a lot of due diligence that has to be done that is not easily findable, I think, for a lot of investors. It's technically public information, but honestly, it's one of those things where, like, if you have to look at like page 109 at footnote B to find out something relevant about how the index is constructed, I'd argue that's technically public knowledge, but like most people are not going to find that piece of information. And we found lots of stuff like that.
So what I'm hearing is it's incredibly complex. If this, like we have this vision of indexing that's the simple answer, but it's quite different in reality and then in execution.
I think it should be complex because I think, if you're hiring an active manager, I think the bar is higher. And you want to ask questions about like, well, what is your investment approach and how do you refine the investment universe and how often do you reconstitute, which is another thing that I forgot to bring up before with the indices, which is how often do you change your holdings, right? Like, there's a ton of questions you should ask about an index manager or an active manager and do some due diligence. And I just don't get the sense that we do anywhere near enough of that in the indexing space. I think people log onto a brokerage account, sort by expense ratio, and choose the cheapest one. And that's about as much due diligence as they do. And there's so much more that goes into it. And it matters too, right? Like all of these things really impact the investment experience. We mentioned before the reconstitution effect. You pulled up the chart that shows that, on average, stocks kind of appreciate by 9% before they get added to the S&P 500 after the announcement happens. And, the reconstitution event is a great example of like why it matters to dig into this a little bit more because you might be in a fund that you pay 3 basis points to own. Well, if the reconstitution effect costs you 20 basis points a year, it doesn't show up in the expense ratio, but it absolutely is part of what you need to consider when you think about performance. And so there's lots of these little things about the way indices or index funds trade and, again, the securities lending revenue and all this good stuff that requires some due diligence. And it should. It's an important decision to make, right?
Yeah. I'm glad you brought that up, Rob. I mean, like, it matters so much. And I think one of the downsides of index investing is that it's maybe conditioned us to think that it doesn't matter, right? Just put it, in Warren Buffett, right? Just put it in the S&P 500. But I think investing is it's a game of inches that adds up to miles over an investor's lifespan. And so those questions like matter tremendously.
It's one of the reasons why I very rarely see index on index violence. And what I mean by that is you don't see indices directly attacking other indices. And I think that's good for all indices, right? One time I remember, I think I was on LinkedIn, I remember seeing something about, I want to say it was Russell. saying that, broadcasting like, we have this stock and you probably don't have it in the S&P, because they knew that you didn't have it in the S&P, right? And on the surface, it seems like a good attack for one index to have against another. It'd be like, well, we've got it and they don't. So don't you want to come invest with us, right? And you kind of see some of this a little bit with SpaceX too. But the problem with that is then you start to dig deeper. Okay, why do you have it? Why don't they have it? And then the more you kind of get down this rabbit hole of, well, how did you arrive at that decision? And where can I ask somebody about this? You start to uncover answers that maybe you weren't expecting and maybe you don't like. And so it's actually better for indices, I think, in some ways, to just say, like, we are the market and you've kind of arrived at a decision for different reasons, but like, here's broadly what we are. And yeah, we publish a rule book and you can read it if you want, but like nobody does. Yeah. And I think, again, that's something that's worth exploring a bit more.
Rob, this has been fascinating. And, I'm taking away just a lot of good information about the indexes, construction, things that we kind of took for granted. Like Andy said, it kind of coaxes us into not worrying about those things that are still valid. And I'm also starting to question, like, what's really passive? Maybe the answer is nothing. But I love to, the pros is better than active. We've come a long way in our progression, like you said, the Wright brothers, and we've progressed a lot since then as well. And I love to hear, because a lot of our 401ks own dimensional fund investments. And so if you could kind of, it's like there's this third option. You guys, I don't know if it's right to say you're a hybrid, if you will, of the index versus, because I know that you've got some formulaic decisions, you got some humans involved. Can you touch on that a little bit? Because a lot of our clients do use dimensional funds along with others similar. What is that third option?
Yeah, great question. I love this because it brings me back to when I was interviewing at Dimensional, and I got asked by one of our deputy heads of portfolio management. I was a PM for many years here at Dimensional, and he asked me, well, how would you classify Dimensional? Are they active or are they passive? I remember hearing Eugene Fama before say that he has absolutely no respect for active managers. So I was like, you can't be active. But the funds are designed to outperform benchmarks, which means by definition, they aren't passive. And so I kind of like stumbled through the question and just explained it like I will in a moment. But it's a tough but good question, and it's worth thinking about. I'll back up a little bit, though, and say that our founders here at Dimensional came from creating the very first index funds. They had worked on them extensively. They knew them backwards and forwards. And as you correctly pointed out, there's a lot of good things associated with indexing. So when they started Dimensional, they wanted to protect the core tenets that people love about indexing. What do you love? You love diversification. You love transparency. You love low fees, right? And you don't want to have this, you don't want to create these scenarios where if you're an active manager, maybe you outperform the benchmark by 10%, but maybe you miss and underperform by 10%. Because we know that investors tend to value that negative 10% as like a greater impact on them than the up 10%, right? So like if you lose 10%, you're going to be devastated. If you're up 10%, you're like, great. But it doesn't sort of wash out in the end. And on top of that, most active managers tend to underperform in the first place anyway. So when we built Dimensional, part of what we were trying to focus on doing was, are there long-term systematic ways to build portfolios to protect all that great stuff in indexing, but enhance the returns to achieve some level of outperformance? The goal is not to outperform by 8% in a year, because how are you doing that? You're taking a huge swing. But can you be smart about picking up some basis points here and there about the way that you trade, for example, or the stocks that you exclude from your investment universe, or incorporating some factor tilts into your portfolios, like, a little bit more in small caps or a little bit more in value and what have you. And that's been incredibly successful. When we look at our track record over 20 years, at least on the equity side, for funds that have outperformed on a net of fees basis, is 80%. And the weighted average basis that you have of that outperformance annualized is like 70 bips, which is really strong, right? Like you might say that, for an active manager, they should be going for more, like at least a couple percent. But the problem is that people can't really achieve that. So if you can be smart and just do a little bit better than the indexing, although I'd argue 70 basis points is a lot, but some level of that outperformance, just achieve it sort of in a more systematic way. That's a great way to sort of make sure that investors who love all the great things about indexing can still have that protected, but do it in a little bit of a better way.
Yeah. I think one of the things that Dimensional and you guys are not the only ones doing this, but it is interesting because it takes discipline in a process. Because when Andy and I are investing in a ETF, and let's say it's value or small, we know what we're getting. We don't have to worry about like, oh, wait a second, there's some large growth in there. You know what I mean? Like this, where'd that come from? So there's that discipline and the research that, it's small is very volatile. It's going to, sometimes it'll outperform, sometimes it'll underperform, but at least the discipline is there to know that, yep, we're in that small space, and we can kind of trust that as well. So.
Yeah, two things you said that I think are really important. One is, again, sort of that style purity. We talked about it from small cap, but I was just looking at major index funds and what they hold. Anywhere between 15 to 20% of value funds that has value on the name is invested in Mag 7 names that you'd recognize and say, there is no way that's value. Or just it doesn't pass the sniff test, right? So you can you do get some of that, exactly as you said. But then also you mentioned also the volatility of small caps, and that is true. Small caps do tend to be a little bit more volatile than large caps. The good news is they don't perform the same. It's not like a high beta play, is that sometimes small caps are up and large caps are down, or vice versa, right? It provides a diversification benefit. So you kind of have this total portfolio approach to it when you have PhDs and Nobel laureates on your team who can look at that and say, well, actually, it's the volatility gets dampened by this offsetting effect that there's not perfect correlation between these two assets. So you kind of get to have a better investment experience from diversification returns without sacrificing too much in terms of standard deviation or volatility. And that's great, right? And that transparency that we share with people, and we're like, here's what the research tells us, and here's what you can kind of expect in terms of tracking your performance. Here's what we've seen historically because we've been around for 45 years. That's all comforting, right? This is tried and true. And I think, again, the basis of it being in rigorous academic literature, and also just in practice, being put in practice in our portfolios, helps people stay the course. And ultimately, that is the right thing for end clients. The best plan that you have is the one that the advisor has set for you. It's not whatever you hear on the news. It's not whatever the flavor of the week is. So if you have that conviction, if your advisor have that conviction, everybody's working on the same team, that's really what we find is driving success over time.
Awesome.
Yeah. I think this has been great. Rob, is there anything you want to make sure we hit on, or questions you wish we had asked before we kind of do the show wrap up?
No, I think it was really important for you at the end to be like, well, look, indexing does have benefits, right? And I do think that's absolutely true. So I think from our perspective, indexing isn't the worst thing in the world. It's just there are things that people probably aren't aware of in association with indexing. It's always worth monitoring some of these stories, and Dimensional does a great job of publishing a lot of content about this. But then I think it's good as an investor to just take a step back and think about, what would I want to have happen? What would I want my portfolio to look like? What would I want my portfolio manager to be doing? Now, don't think about an index. Don't think about an active manager. So ideal world, what would you want? Would you want to have somebody looking at the holdings every day? Would you want it to be informed by research, right? Would you want it to be fully transparent? Would you want the goal of the portfolio to be to outperform by some amount, any amount? If all of those things are true, then I think it's worth calling into question whether or not indexing is right for you. And the good news is this conversation isn't just cause a bunch of problems and start a fire and walk away, right? And you're like, well, indexing is not great. You solve it. We feel like we already have. And so I think it's worth, once you've gone through some of that independent soul searching about what do I want my manager and my portfolio to look like, to come back and say, who fits that bill closely? And I think we've got a great answer here at Dimensional.
Yeah. Right on. Rob, this has been awesome, man. I appreciate it. And again, really enlightening for me too. And I think wrapping up today, this is kind of could be somebody's first step of do your homework, do your due diligence. That's kind of what our mission is as well, is try to help simplify some of these things that are complex. And like you said, they're complex because it's important, at times as well. And sometimes there's a better way to do things. We learn things. We learn better ways to do things. So we appreciate that. Do your homework, get a plan, like you said, and stick to it. Have the discipline to stick to that plan, and especially when the going gets tough, which it always will at some point in the market.
Yep. That's exactly right.
Headed this way. But Rob, we are super grateful, man. We really appreciate it. And I know that our listeners are better off for it. So thanks for your time today. We appreciate it.
Of course. Thanks for having me on. Appreciate it.
Right on. Take care. Bye-bye. Hello, Pilot Podcast family. Charlie here. I just wanted to share with you something we've just recently developed. In the show notes, you're going to see the Pilot Wealth Index. We want you to check it out. Give it a shot. It's a quiz, a short questionnaire that allows you to understand, are you on track? We have a lot of people that say, hey, we just want to know if we're on track. Are we where we should be at this stage of our flying career, airline career, whatever it might be? How am I doing? Am I close to my peer group? Am I behind? Am I ahead? We've developed some questions, some metrics that we think if you go through this and check it out, answer the questions, you will have a very good idea of where you stand. We developed the questions that give an indication of, are you doing the right things you need to do to be prepared for an eventual retirement and that one that can be profitable for you. So check it out in the show notes, the Leading Edge Pilot Wealth Index. We hope you give it a shot. If you have any questions at all, reach out. Happy to help. Charlie at leadingedgeplanning.com. Again, that's Charlie at leadingedgeplanning.com. You can call or text me on my cell, 865-328-4969. Thank you very much.
Thank you for listening to the Pilot Money Guys podcast. Please subscribe, rate, and review on iTunes or wherever you listen. We are grateful for your reviews because they encourage others to listen in. Visit leadingedgeplanning.com to learn more and subscribe to our newsletter. Leading Edge Financial Planning, LLC, LEFP, is a registered investment advisor. Advisory services are only offered to clients or prospective clients where LEFP and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.